Recording in progress.
Okay, perfect. Good to see you guys. So this is Sacred Account Saturday. I want to welcome everyone here that's tuning in live here on Zoom, on Facebook. If you're watching this on YouTube or any of our other platforms, listening to this on our podcast, I want to welcome you today. So my name is Jerry Fetta. I'm the owner, founder, and CEO of Wealth Dynamics. And so what we're going to be talking about today is going to be sacred account frequently asked questions. Okay, these are the most oftenly asked questions we get from clients and people who are interested in the sacred account. So I'm going to be sharing those with you today. Before we jump into it, I do want to make sure we cover a few ground rules. So the first thing is, if you're tuning in live here today or watching the replay, I would like you to make sure you've got your purpose figured out. Why am I here? What am I trying to get from this call today? Right? So, if you're watching this and you don't have that yet, it's always going to be harder to learn. It's always going to be harder to get information from something if I don't know why I'm there and what it is I'm trying to get. Okay. So that's the first thing. The second thing is, make sure that you've got your, your goals, but also realizing that I can learn about money. This is not something that's going to be, reserved for just the wealthy already. That's one of the misnomers that people have is like, hey, I'm not wealthy. This isn't for me. Okay, well, you get wealthy by learning about money first, right? We're not going to succeed with something that we don't have any information about, right? We're not going to be able to win with a tool that we don't have any data on, no experience. We don't know how it works. We don't know how it operates, right? So we have to have this idea of, okay, we can learn about money. Okay, that's the first thing. We can learn about it. And by deciding we can learn about it, that opens up the door to it being a possibility. So that's going to be the point of that. And the other one is really, making sure that you're open-minded to hearing things more than once. There's the, I've already heard this before, or I know it all already. I don't need to know this again. I don't need to hear this again. That's really not a great way to go about it, right? So, there's no pinnacle of knowledge. There's no, I've heard this and I don't need to learn it anymore. I like to relate this to going to the gym. You don't just go once, you go daily, right? It's kind of like learning. You can't be like, oh yeah, I read. Okay, but are you learning every day, right? You can't become educated if you don't. So, those are really the main things I want to cover. And then really quickly too, I want to make sure we're sharing this stream here. So if you're watching on social media, go ahead and share the stream out. If my staff can make sure we put this out on our pages, let's do the sacred account business pages, all the personal pages. Let's get these out there. And if this is something that helps you, I would love for you to share this so someone else can see it and be on this afternoon. Okay, so without further ado, I do want to introduce my team and what our intention is with this webinar with you today, right? So there's really three groups here that I'm going to address. The first one is if you're already a client of ours, okay? If you're already a client, one of our goals is to help you make more progress, right? And so we want to answer your questions. We want to use this as a time to service you and make sure that you are getting, help and you're being, taken care of as far as information and things on the sacred account if you've got one already. The other one is you're interested in setting an account up, right? And so really our goal here is to give you enough information today to make a decision. So whether you're watching this live, whether you're watching the replay, when you make that decision, you've got to have all the data. And so this is really about giving you that data on, okay, this makes sense. My questions are answered. This is something I want to move forward with, right? And last one is somebody that they're just checking it out. You're not interested yet. Maybe this is the first time you're seeing my content and material. And this is something that, you're kind of exploring. And so really, you kind of know about the content already. I guess at this stage, my goal for you today is for you to decide, hey, I like this and I trust this. I think it can help me. And that's going to help you further get more information so you can get started with this as a client. Okay. So the other thing I want to go over really quickly is my book. Okay. We've talked about this on previous webinars. So this is my book, Blueprint to Financial Freedom. And so a lot of what we're going to cover today is going to be stuff from this book. Okay. And I want to give you a free copy if you're watching this, right? So I spent, the last 12 or so years of my life in the financial services industry, learning about money, learning about finances, studying the top 1%, looking at what they actually do, right? And then what happened was I spent a long time getting the information and then running trial and error on it. Does this work? Does that work? What's the correct sequence? Where do you go for this? How do you do that? And there wasn't an outlay or a blueprint that I could follow. So it took a lot of my time. It took a lot of my attention. There was a lot of mess ups, failures, losses, things that didn't need to happen. Okay. And so when I finally got it down, what I did is I said, okay, good. I'm going to write this in a book. Okay. So this is, probably a 6 to 8 hour read full of information here on how to build passive income. How do you become financially independent? How do you build wealth? How do you build passive income? but how do you do it like the top 1%? Okay. And so I want to offer you a free copy of this book today if you don't have one already. If you go to jerryfetta.com/B2F promo, you can get a free copy of the book. You cover the shipping, and then we'll send the book out to you. So that's the link there. And then finally, we do have our wealth mentors here live in the chat, right? So if you're watching today on Zoom or on social media, I want to introduce Rodrigo Torres and I want to introduce Brianna Shaw on our team. They're endorsed wealth mentors of mine. And so they're going to be reaching out to you along with Joe on my team too, just to find out, do you have questions? Do you want to set up a free call? Do you need help with anything? So if you get a message from Joe, you get a message from Rod, you get a message from Brianna, that's who they are. That's what their goal and purpose is. Okay. So without further ado, let's go ahead and jump into our material today. So this is Sacred Account Frequently Asked Questions. We will be sending this one out as a replay as well, probably on our training sites for our clients as well. So that way we have all the information on when these questions are asked, making sure they get covered, right? But the Sacred Account FAQs. Okay, the first one here is, this is a frequently asked question, the difference between a direct recognition company and a non-direct recognition company, right? So let's go ahead and cut this back a little bit. I'm going to sketch this one out for you guys. Okay, so you have two different types of life insurance companies as far as like dividends, right? So we have a life insurance policy. That's what the Sacred Account is, right? It's high early cash value, right? And it pays dividends. And then we can also borrow against the cash value in our account. So when we're looking at this, there's two different companies and two different ways loans are done, right? So the beauty with this system is, okay, I'm earning a dividend. My rate of growth over here is maybe 3 to 5% on average. I can borrow my money in my cash value. I can use it, still earn the 3 to 5%. I can use this to maybe pay off debt or invest in real estate where I'm earning 8 to 12%, right? And then my cost to borrow is generally going to be a cost of about 1 to maybe 3% if I set my loans up correctly, right? Now, the dividend crediting, like when the company pays the dividend, that's a percentage of their profit. And they're paying that dividend to you because as a policyholder, they're going to treat you like a shareholder. You're an owner in the insurance company. So if I have a policy with Guardian, I actually am an equity owner in Guardian. If I have a policy with One America, I'm a shareholder in One America, right? If I'm with Lafayette Life, I have shares in Lafayette Life now. And that's why I get a dividend, is that's where that profit, that's that share that they're giving back to me, right? Now, there's two schools of thought with the different insurance companies. There's what's called direct recognition and non-direct recognition. So what this means is direct recognition generally means when I take a loan, I earn dividends, but only on unloaned money, right? So let's say that I have, just for example's sake, let's say that I have $100,000. Okay, my $100,000 is growing and it's earning dividends, and the rate of growth is about 3 to 5% per year. And I borrow $50,000 against this, right? So what happens is the insurance company says, cool, when it's direct recognition, generally, cool, we're only going to credit you the 3 to 5% on the 50 you didn't borrow. So we're going to reduce your dividends on the entire amount you loaned out. We're not going to pay you dividends on that money, and we're only going to pay it on what you actually did take out, or sorry, what you didn't take out, what's remaining in your cash value. Now, the reason they do this is their school of thought, their viewpoint is that it's unfair to all of the people who didn't take loans to be paying, dividends to people who are, right? So they're like, hey, everyone's getting a piece of the pie, everyone's getting profit. Those that aren't taking loans, we're going to credit them the full dividend, but we don't want to credit the dividend to those who do. We want to reduce their dividend because it's not fair to pay a dividend to someone that's taking a policy loan, and it's not a fair benefit to the guy who's not taking a loan, right? That's kind of the viewpoint behind a direct recognition company, right? And I can kind of see that. I'm like, okay, I can understand that. Do I like it as a policy owner? No, that's not how I want to set mine up, right? So the other option here is called non-direct recognition. Okay, so non-direct recognition means when I take a loan, They take my loan. They're going to pay dividends. I'm going to earn dividends on the entire amount. Even loan funds, right? So I have 100K. I borrow out 50, right? So I've got my $50,000 loan over here. And they're going to pay dividends on the entire 100K. So I'm going to earn 3 to 5% on all of my money. Right now, can you see how the difference is like for the different like loan setup? So let's say I'm talking to Nick here. Let's say that Nick has a non-direct recognition policy, and so he takes a policy loan. He's going to earn dividends on his policy, like the loan never happened. And I didn't take a loan, and I'm going to earn the same thing. Right. So in that scenario, it's kind of like, you know, use it or lose it. You can take the loan and earn the dividend and double dip, or you can just leave the money there. Versus a direct company recognition company, Nick has a policy, takes a loan. I didn't. The insurance company is actually rewarding non-loan takers. They're saying, hey, we're going to penalize you a bit to take a loan. We don't want you to necessarily be taking loans, right? If you do, you're not going to get dividends. We're not going to pay you if you take loans out, right? Now, the exclusion here is there's a company we work with called Guardian. Okay, so Guardian is a direct recognition company. Okay, but what Guardian does is a bit different. So generally, Guardian, their dividend rate is going to be around, I think 5.6% or 5.8% is what it's been. That's their gross dividend. Their loan interest rate in the past has been around 6%, right? And so because of this, when you take a loan with Guardian, they actually increase your dividends to match the loan rate. Right. So it's direct recognition. They directly recognize the fact you're taking a loan, but their response to it is a bit different. They're saying, cool, we're going to make sure your dividend and your interest rate are flush. Right. And so that's why Guardian still works for this, because I can pay my interest down. I'm still going to earn the full dividend, and I can make sure I have that positive spread there still. Right. Which kind of does shelter risk a little bit. As you can see here, these are gross rates. So a 5 to 5.6 to 5.8% gross rate, meaning before fees and reinvestment and stuff, it's going to come out in the long run to about 3 to 5%. A 6% gross interest rate, if I never pay my loan back, yeah, I'm going to pay 6%. But if I pay my loan down, I'm really only paying about 1 to 3% in actual interest costs, right? So I can still make that spread of the 3 to 5 minus the 1 to 3 with something like this, right? So Guardian does work for that, even though they're a direct recognition company, and that's one of the reasons we use them. Okay, the rest of the companies we use are non-direct, right? So you take a loan, they're not going to recognize the fact, they're not going to reduce your dividends. Okay. So that's the differences on the non-direct and direct. I know that that's a bit wordy, but I wanted to go over that because that is a question that we get, especially now, you know, in 2023, I'm going to date the video a bit. In 2023, we are, you know, dealing with a lot more carriers, a lot more insurance companies. And so when you sign up with us and get a Sacred account, you're getting access to, you know, 5 or 6 potential companies. And so it's like, okay, cool. Well, there are differences and nuances with each one. This one does this one does that. And so one of the questions we've been getting is that question of, okay, well, the rest of the companies are non-direct, Guardian is direct. Why is that? Right. So this is another question. I want to pay, I still want to pay in my lump sum in the first policy year, but not the whole amount at once. Can I do this in installments? Good question. So I'm going to sketch this one as well. So what this person is saying is, let's say, for example, I want to put in, you know, $100,000. And let's say I'm going to follow this up with $10,000 per year. Right? So 100K lump sum, 10K a year contributions. Good. We've got that. Now this person is saying, okay, well, I don't actually want to put in the full 100 right now. Okay. I want to do maybe a portion of it now and do some of it later. It doesn't really work like that. For it to be a lump sum, it does need to all go in at once, right? Otherwise, it's not a lump sum, right? By definition of being a lump sum, it means at one lump point, like one lump sum, I dumped all the money in. So if I'm taking this 100K and I'm instead spreading this out over a number of months throughout the life of the policy, and I'm doing a deposit here and deposit there, deposit there, deposit there each month, really what I'm doing is I'm not doing a 100K lump sum. Right? Let's say I'm doing a $50,000 lump sum instead, and I want to spread the other 50 out. Well, really what's happening is I'm just going to do 60K a year in contributions. Right? Do you see how that works? Now I can do that through contributions on a scheduled basis. right? Scheduled, or I can do that through unscheduled. Okay, scheduled means I am contractually obligated to put this money into my policy every month or every year, whatever I've picked. So if I tell the insurance company, hey, I want to do 60K, guess what they're going to draft from my bank account throughout the year? 60K. It's forced, it's automated. I cannot reduce that number, right? Instead, I could say, hey, I want to do 50K lump sum. I want to do maybe 20,000 per year in contributions. And then I want to do the other 40,000 in unscheduled paid up additions. Okay, these are cash deposits. They're not scheduled. It's not something that I'm going to have to be on the hook for, right? So that's maybe if I'm a little bit more like, I don't think I'm going to have 60K every year. Good, then let's design your policy to where you put in the lump sum you want to put in, you put in the annual contribution you want to put in, and then we put enough of this in to get the unscheduled limit high so that you can put in those paid up additions and be able to fund that policy with some flexibility throughout the year. Okay, so that's how this one's going to work. Okay, let me just take a pause here and see if there's any questions we have off the cuff. Good, I don't see anything so far. And again, if you guys have questions, drop those in the chat. The next FAQ that we have here, it says, how can I pay the difference in my premium to be fully paid up before my current policy year? All right, here's a good question. So basically this person is saying, okay, I'm going to be doing, let's say in my example of a policy, I'm going to be doing $1,000 a month, 12K for the year, right? And so every month I'm going to contribute, I'm going to save, I'm going to deposit into my banking system, my Sacred account, $1,000, right? Now, this person is saying, how do I just pay it off for the year? What if I don't want to do the annual thing? Let's say I'm 3 months into it. I've paid $3,000. I've got 9K right now that I can do. And I don't want to keep up with monthly payments. I just want to fund it now. And the reason someone might do this is because they're maybe not great with the cash. They're worried, hey, I might spend it. So I want to stick it in my policy while I can. Or the other alternative is that this individual, they need to use that money for something. They're going to put it towards paying off debt or making a purchase or something of that nature. So they want to do a dump in. Okay, so what you would do on this one is, let's say you're monthly, you're doing $1,000 a month, 12K for the year, you're 3 months in, and you're like, good, I want to just pay the year now. You're going to switch your billing method to annual. That's the handling. Switch to annual billing. They're going to draft the 9K now. That's going to fund your policy fully for the year. You're going to have no more premiums the rest of this year. You could still potentially do some unscheduled deposits with your paid up additions. Now, next year, when the new year starts, you either want to keep it annual where they're going to say, good, you're on the hook for 12K now, or then you might switch it back to monthly if you don't want to keep that up, right? So there's some flexibility in your billing mode, monthly versus annual. Okay, here's a great question. If I got rejected by one insurance carrier, what are the chances of being approved by another? All right, so this can happen. So when you're getting a Sacred account set up, right, it's important to realize it's not an entitlement. It's not something you're automatically going to get approved for. So you have to go through financial underwriting, medical underwriting, and pass a background check. Okay, the insurance company, they're putting money on the line. They're saying, we're going to pay for this person when they die. We're going to insure their life and make them a partner in our company. So we need to find out, like, is it like they're going to die next week or they're going to be around for a while? Because if they're going to die next week, we can't afford that liability. We can't have Jerry pay $1,000 and then next week he dies and we have to pay out $500,000. We can't stay in business if that occurs, right? So that's one of the things they're looking at with the medical underwriting. The financial underwriting, same thing. They're looking at, okay, this is a very secure account, can't be taxed. The government can't get at it. Creditors, lawsuits, all this stuff, it's off limits. So we want to do some financial underwriting and make sure you're not laundering money. We actually had a client case that they're looking to put several $1 million into their policy. $2 million per month is the amount they're looking at. And they're looking at pulling that money out right away. And then it came up with the insurance company like, hey, what's going on? This kind of looks like money laundering, right? Why are you putting money in and pulling it right back out again? And so these are things the insurance companies are going to look at. They're going to pay attention to this, right? So with this being said, the insurance companies, they're going to do financial underwriting. They're going to make sure you're not, a criminal. They're going to make sure you're not a terrorist. You're not involved in drug trafficking or whatever the thing might be, right? Now, the other thing is they're making you a partner. So they want to make sure that you're not a bad partner. A bad partner, you don't have bankruptcies. You're not someone that's going to screw them over somehow. You don't have a criminal history. Like these are things that they are paying attention to, right? So when you go through this process, it can take 6 to 8 weeks on average to get approved if you get approved. So the insurance company might say, hey, we found this in your record. We don't want to give you a policy with us. Okay, what do we do in that scenario when that happens? What's the handling? So let's say we do that with one company, and then we come back and we say, okay, here's why they declined. They said, because of this reason, we're not gonna cover this individual. Okay, now we can go back now to another carrier, a different carrier, and reshop. Now, we don't know for sure if you're going to be approved. So here's where it's just part of our process. So we're going to try and approve you first. If the first carrier rejects, we're going to go back to the others. We're going to say, hey, can you guys do it instead? If they say yes, awesome, we're off the hook. Let's get it handled. Okay, if they say no, we can't do it, then we're going to say, okay, fine. So then let's go and let's maybe put insurance on, a spouse or a child or something else, right? And that way we can still have a policy that you own, but it's not going to be, one that's necessarily insuring you. It's going to be insuring someone else. So then we can get you set up with a policy still, right? So those are really the three handlings: is yourself with another company, or insure someone else and you be the owner, right? And the only time that you're not going to be able to be the owner is probably the criminal record, or if it looks like you are doing weird things with money, like money laundering stuff, then they're going to say, yeah, we don't even want you to own a policy, right? And if that's the case, then we really can't help, right? Because at that point, the insurance companies, they don't do this on a whim. So they're not like, we think there might be some criminality, so maybe just to be safe. No, if they say it, it's for sure. This person's a criminal. We can see that. We can see suspicious activity. We're not going to bring them on as a client. And if that's the case, then Wealth Dynamics really can't work with that person either. So that's what happens if you do get declined, and kind of what that happens. This person asks, how can I update my bank account info for premium auto draft and switch from bank wire to ACH type of payment? So that's not something that we really do. So if you set up a Sacred account, you need to be on auto draft, right? That's the point of the Sacred account. It's a forced automated savings plan. So if I'm trying to avoid being on a forced automated savings plan, then the Sacred account is not for me. Okay, if I'm trying to avoid having that kind of responsibility and accountability in my life, the Sacred account is not for me. Right? This is for somebody that knows I need to be on a forced automated savings plan. Here's the thing: the IRS takes your taxes on a forced and automated basis. Wall Street takes your 401k money on a forced and automated payment, right? The banks, they take all your money on forced and automated payments. So why wouldn't you, the only one in this equation that's actually looking out for you, save your own money in your own bank on a forced automated basis, but you would save it that way in someone else's bank? You would make your mortgage payment on a forced automated basis. That's someone else's bank. You do direct deposit with your paycheck into someone else's bank. That's a forced and automated basis. Why would we want to be, stuck flowing money to another institution, another bank, and then avoiding having the commitment with our own? To me, that sounds like the priorities are out of whack. I want to fund your bank, but not mine. Okay, that's like if I own a grocery store, I'm going to go shop with my competitor. Right? That doesn't make any sense. I own a car dealership. I'm going to buy cars from the people across the street instead. No, use your own system. You have your own bank for a reason. You wouldn't be funding someone else's if you had that understanding. Okay, so someone says, what can I do to get an in-force illustration? So if you have a policy that's already in force and you've funded it, you put money into it, and you want to see what's the performance like, how's it doing, right? You can do what's called an in-force illustration. An in-force illustration means that we're going to take a look at, okay, the policy has been in force now for however long, and we want to see the performance. Okay, so we're going to run the performance based on current dividends and growth and what your account value has done, and then we're going to send that to you. So the way that you do that is, if you're a client of ours, you can reach out and say, I'd like to get an in-force illustration. If you're a client with our mapping team, you can actually have them put that together for you, and also do custom reports if you've got a policy that's in force and funded. Otherwise, we go directly to the carrier, and the carrier is going to pull an in-force illustration. And they're just going to show, hey, you funded it this many years so far. Here's what you've got in cash value based on the current dividend projections. Here's what your death benefit looks like it's going to be each year. Here's what your growth looks like it's going to be each year. Someone asks, what is initial face amount and how is it established? So this is more of an insurance term. I'm going to just break this one down for you guys. Okay. So face amount refers to the total death benefit coverage on a policy. So face let me make sure I've got my typing work here. Face amount equals total death benefit. Okay, so that's the face amount. Okay, so when someone says, how is that determined? Like, what's the total death benefit initially determined? How do you do that on a policy? So we're going to look at a couple of things. Determining death benefit comes down to a few things. First thing it comes down to is the design. What are we trying to accomplish? Okay, so this is the purpose of the goal. What are we, the policy? What are we trying to do? Right, if we're trying to fund it for really high early cash value and borrow right away, we might do a little bit more death benefit to increase the MEC line so you can dump more money in. If you're going for a longer term growth, we might go for a minimum whole life death benefit, stretch that out and have it growing longer, right? So that's going to be based on design. The other one is going to be based on health. Okay, how insurable am I? And what are my rates? Right? So I'm going to have a limitation based on that. The other one is going to be based on my personal income. Okay, they're typically going to give me a max death benefit based on multiple of income. Okay, this is the most you can do times your annual income. That's what we'll put in force for you. And then finally is my budget. Okay, what can I afford? Right? If I'm saying I want a giant death benefit and I want to have the perfectly designed sacred account and this and that, but then I'm like, and I can do $300 a month, it probably won't happen. Right? So we're going to look at, okay, well, you have $300 a month. Let's show you what we can do with that. Okay, what's your goal? What are your rates? What's the multiple of your income? What can you afford? So those are really the things that go into determining that face amount. And that's what a face amount actually is. Okay, next FAQ. To do a premium sacred account, do I need to open a second policy or can I switch my light account to a premium? Great question. So with the sacred account, we have two different versions. We have one that is called the sacred account light. I'll go ahead and type this out for you. Okay, this one is going to be a 7 to 10 year fund. We're focusing on high liquidity in year one. It's going to have lower overall growth. Okay, it's going to have no extra riders. Okay, riders are extra benefits, things you might add that have a fee or you pay for to get extra growth or, extra payouts or whatever, right? And then this is also going to be, generally used for either paying off debt or building reserves. Okay, this is why we start with the light. When someone's brand new, we want to get them money early. We want as much available right away. They're usually paying off debt. They're building their 6-month reserves. And so that's the light account. Okay, now the premium account is a bit different. This is 20+ year funding. It's designed it will have high liquidity, but it's a little bit maybe less because it's focused on growth. Okay, it's going to have higher overall growth. It will have extra riders available. This is focused on investing, wealth building, long-term, right? This is really the differences. So most people, when they sign up with this, they're going to start with the sacred account light. We want to do this one first. Okay, we're going to start with the sacred account light, right? Now, at some point when they're ready, they're going to come to us and say, hey, I did my light account. I'm ready to start my premium. I want to do it, what we would call maybe an upgrade, right? Now, that does not mean that you're going to convert the light account to a premium. You're going to get a light account, and then we're going to add a second account, which will be your premium account. The only time we can do an actual upgrade and convert the light to a premium is if it's before you've even signed your application, right? Like you sign up today for a light account, and then 3 days before we do any paperwork, you're like, hey, actually, I want to upgrade it to a premium. We're like, cool, no problem. Let's set it up as a premium instead. Okay. As soon as you sign your application, it's too late. You cannot change the policy, right? From a light to a premium. Okay. So that's really the point of no return there. Which is pretty early on in the process. So if you've got your account and it's in force, then it's really not going to be a thing that we can change it from a light to a premium. Can I start the policy with a monthly premium less than I applied for and then increase the original amount as soon as increase it to the original amount as soon as I get extra income? So not necessarily. Like if you said, hey, I want to start with $1,000 a month, and then we're like, cool. And then we get you approved and you're like, actually, let's do 500. We can change it to 500, right? But once you've done that, you're not going to later then be like, okay, cool, let's bump it back to 1,000 again. So whatever you signed for is what's going to go in force. And whatever goes in force is what you have now. Now you could do unscheduled paid up additions. You could say, I'm doing my 500. I've got some extra cash. Let me dump that into my cash value throughout the year on an unscheduled basis. Okay, that's totally fine. Okay, the other thing you can do is you can open a second policy. Right. So I say, good, I started with 500. I want to do 1,000. So let me just open another policy for 1,000. Right now, I want to really stress opening a second policy is actually a really, really smart thing to do. It's not like it's a bad thing to have two sacred accounts. Sometimes clients will get this like, I don't want to have two. Why not? It's like having two houses or two Lamborghinis or having, two ice creams. Like, why would you not want two more of a good thing? Right. So there's no benefit in just having one that isn't going to be bettered by you having more than one. So if you're like, hey, I can only do this much right now, let's back it down, let's start lower. Great. Let's just plan on opening a second policy for you as soon as we can. Okay, good. How long do I have to decide to move forward with the application and approval to take delivery? Okay, this one is a pet peeve of mine. So I'm going to be a little bit upfront with you guys. If you sign up for a policy with us and my team, who we have on payroll, who spends their devoted, precious time building your policy, works on it for 2 months in a row and then sends it to you, and then you drag your feet and don't take delivery, we're not going to give you much time, right? Like, you need to make a decision. You had 2 months to think about it, right? Like, what more? Why do you need more time at this point? Okay, what was going on for the last 2 months, right? So when we set up a policy, like, realize it's a lot of work. It's a lot of work. It's not just like, oh, we whipped one out of thin air and there's no work with it. And no, we did a lot. Our team did a lot. We have full-time staff that they're trying to service you. They're trying to do their job and do a good job for you, right? So sometimes, and it's not often, but sometimes we will get these crazy people who buy a policy, they sign up, months and months go by, they're difficult to get a hold of. We finally get it done. We send it to them. And then they're like, let me think about it for a month. Right? Or they're like, oh yeah, I don't get paid till 3 weeks from now. Right? That's just a lack of planning. That's irresponsible. Right? Like, as the CEO, like, my staff are maybe nicer than me on this point, but as the CEO of the company, if I'm sitting there with you as the client, I did all this work, and then I see that this is happening, I'm like, cool, we're not going to do your policy anymore. Go somewhere else. We have too many people to help. We can't spend time on someone that's indecisive and dragging their feet. Put your policy in force. Right? We're trying to help you. You're trying to save more money. We're trying to help you become your own bank rather than giving to Wall Street, the IRS, or chain banks, or for you to blow it on bad habits or bad financial decisions. We cannot help someone that doesn't want to help themselves, which means we're going to push you to put your policy in force right away. We're not going to give you a long waiting period because there's not much to understand at that point. We did the illustration. It's been approved. Here's the numbers. Here's what they mean. Does it look good or not? If so, cool. Let's fund it right now. That's it, right? So I get a little bit irritated on that one just because I've seen it happen, not a lot, but when it does happen, it's like, okay, that's not okay for someone to do. Let me just back up one point. Imagine being a waiter at a restaurant or a chef and someone orders their food, you deliver it to the table, and then they always come back and they're like, how's the food, right? And the person's just sitting there and they haven't touched it and they're studying their plate, telling you, I need some time to think about if I'm going to eat this. That's not okay to do. You see how weird that is, right? It's like you either want the food or you don't. If you don't tell me now so I can go back to the chef and have them correct it, don't add, 2 hours of time into the waiting process. We have other people who want to come eat. This isn't a museum where you look at the food. It's a restaurant where you eat the food, right? So to me, that's an equivalent. When do I need to pay my first premium or lump sum? At the time you sign for the policy. So as soon as you sign, you should be ready to send the money to the insurance carrier. And you should be planning for that, by the way. Another thing we don't want to have happen is for someone to be like, hey, I'm going to put in 50K, but they don't actually have 50K. And they're like, yeah, but in 2 months, I think I will. No. Let's fund with money you actually have. Because what happens is we get there, we're like, cool, it's done. Let's do the 50K. And you're like, I don't have the 50K. Awesome. We have to go redo our job now, right? So like, really pay attention to like, what do I have? What could I put in? And make sure you keep that money there. And if it's not there, let us know like, hey, I don't actually have this. We needed to make a change maybe. And tell us early in the process so we can adjust things and not have that time wasting happening. If I close my policy early, what is the surrender fee and what will I lose? So first, there's no surrender fee. You don't lose anything. Like you get your full cash value if you close your policy minus any loan interest you owe. But I wouldn't understand why someone would close their policy. It's kind of like saying, I opened a profitable business and it's going well, but I'm going to close it down. What is my loss going to be? Like, why would you close down something that works? Right? Your sacred account is like a location of your own bank, right? Having more of them is like opening up more locations. So why would I be shutting locations down? Am I in contraction mode where I'm trying to build poverty? No, we're trying to build wealth. You want to be saving money. You're going to need to put it somewhere. So you want to put it in their bank or your bank? You want to give it to SVB, the guys that just went under, right? Silicon Valley Bank, where they loaned out all your deposits. And by the way, did all of the things that we tell people banks do. The public is surprised. It's like, yeah, we've been telling you this is what banks do with your money. They loan it out to other people. And then when you ask for it, it's not there. That creates what's called a bank run, where the depositors ask for the cash isn't there, the bank can't pay it, and then the bank goes under. We've been saying that that's what happens. That's why you shouldn't save money in someone else's bank. That's why you should save money in your own bank. The insurance companies that we bank with, that we do our sacred accounts with, they don't do that stuff. Your money's there. It's fully allocated. You can borrow against it anytime. They're not loaning it out and investing it in the options market or stocks or whatever else. Okay, so that's really one, like if I'm looking at closing my policy, it just means that I'm basically being bullied by financial institutions and I'm a sheep. I'm just listening to marketing. I'm not looking at what works best for me and my finances. All right, guys, we got time for one more question here. And we are going to wrap up a little early today, but one more question. So this is what happens if my account accidentally gets drafted more than once this month? So this is a question of like, okay, I've got my policy, I signed up for 1,000 a month, let's say, and for some reason they drafted 2,000, right? So there's really two reasons for this. The first one would be simple administrative error. The insurance company, the insurance companies are run by people. That does mean that there are going to be mistakes and corrections that need to happen. And sometimes they might make an accounting error and we've got to say, hey, you drafted Martin's account twice. Can you please send him the money back? Right? I understand that's inconvenient. And that's not that often, honestly. That's like a very infrequent thing. Okay. The second thing is I put my policy in force, let's say for March, and then I didn't actually pay it till April. So now I owe 2 months. Right? The date that when I apply and I say I want to put it in force on that date, that's the date the insurance company expects me to do. I just signed a contract for it. So it's kind of like signing up for a car, like a car payment with the bank, and them saying, hey, your first bill is on April 1st. Okay. And I'm like, okay, awesome. And then I skip my first payment. And then in May, I wonder why I have 2 payments. Well, because I skipped the April one. So now I owe April and May. Right. So that's really going to be, the reason that would happen. Someone's asking, can we go into difference between the light and premium accounts? Martin, you may have missed that. We just did that maybe 5 minutes ago. So the replay will be out on the light and sacred account. You can check that out again. But Martin, what I would do is if you want to connect with Brianna or Rodrigo on my team, they can go over that in depth with you. So that way you get all your questions answered. Then we can send that replay out to you as well. Okay, awesome, guys. So what I'm going to do here is I want to go ahead and wrap up. I don't see any extra additional questions in the comments. We did have a lot of good interaction. We do have a question. What are examples of riders? Okay, that's a good question. So let me answer this one really quick from Lawrence. So riders, you could add, for example, an index rider. An index rider says that, if the stock market, performance does well, you could actually have your dividend crediting tied to that. You're not investing in the stock market. You don't own stocks. They're just basing it off of what the index did rather than what the insurance company did. So that's an example of a rider. Another one could be a long-term care rider. So if I end up in a nursing home or needing in-home care or something of that nature, basically they're gonna give me a payment for life out of my death benefit, or maybe my income for life rider that would kick in at that point, and I would pay a fee to have that long-term care rider. So those are 2 common examples of riders. You could also add what's called a waiver of premium. Waiver of premium means if I get disabled, the insurance company actually will cover my premiums for me until I'm back into my job, right? There's another one you could do that's called a long-term disability rider. So the long-term disability rider, let's say that I get disabled, they'll actually pay long-term disability income from my death benefit early to cover that, similar to long-term disability insurance. So those are some of the riders that can be added, just to give you some examples. And the reason that we don't add those on the light account is most of those have fees, right? So the light account, someone's still trying to build solvency, and it's already going to have a bit of a lower rate of return. So we don't want to add extra drag to it, like things that are going to reduce that return. So the riders are cool, but let's wait till we do your premium account and we can add those riders in. Awesome. Let me see if we have any other questions here in the chat. Good. I think that covers it. So guys, before we close out, again, if you've not grabbed a copy of my book, okay, I want you to go to jerryfetta.com/B2F promo. Okay, jerryfetta.com/B2F promo. You can get a free copy of the book. You just cover your own shipping. We'll send it out to you. And then secondly, if you did not set up a call with Brianna or Rodrigo, reach out to them in the chat. If they sent you a message, check your chat, reach out to them, let them know, hey, I want to get on a call. They're endorsed wealth mentors of mine, which means that they're going to do what I would do on a call with you, right? They're going to handle you the way that I would. I've trained them myself. We check in with them regularly. They have stringent standards that they have to meet up with to meet in order to keep my endorsement. And so they're going to do a great job with you, right? So if you're interested in that, let them know, schedule that call, today, tomorrow, this week, whenever that is. Otherwise, a couple of other announcements. We do have Mini Mogul Monday with me and Sammy Larone dropping 4 p.m. Eastern time on Monday on our YouTube channel. So if you have kids, grandkids, little siblings, anyone that's young, that's a great way to start educating them on finances, learning about money from a kid for kids. Right. And then it's also, funny enough, a great way for adults to learn too. Like if I'm brand new at this, what better way to learn than like explaining it to an 11-year-old, right? That's how most of us probably do need to hear it the first couple of times. Okay. So guys, without further ado, I do want to wrap up here. I will leave this open. I'm going to leave Brianna in charge of the chat. So that way you guys can still network. You can connect up for calls, that type of thing. If you have any questions or need any help, be sure you do reach out to them. Otherwise, have a great weekend. Be sure you tune in Monday for Mini Mogul Monday. We'll be back again next Saturday at 1 p.m. Eastern time.